You're ready to buy your first home, but the biggest question is this: should you put down 5, 10, or 20%? It sounds like a financial decision, but it actually changes everything. How much cash you need up front, what your monthly payments will be, and even how fast you can buy. In today's market, with average rates and limited inventory, knowing the right capital stack for your situation is the difference between buying this year or getting stuck waiting. So, in this video, we're going to break it all down. No fluff, just real math, the real trade-offs, and a clear way forward. I'm LJ Aguinaga, real estate broker, investor, and a first-time buyer coach based right here in Montreal. I've been helping people buy homes for over 17 years, and I've worked with buyers in every situation: cash light, family backed, high income but no savings, you name it. What I've learned is this: your down payment strategy is not just about how much money you have, it's also about how you structure it. And if you're not thinking about it the right way, you could delay your purchase unnecessarily, or worse, overextend yourself. So, let's unpack how the 5, 10, and 20% options actually work in real life and how you can make the smartest choice for your goals. Let's start simple. When we say you're putting 5% down, what that actually means is you're financing 95% of the purchase price. In Canada, if the purchase price is $500,000 or under, you can do 5% down. If it's over $500,000, up to $1.5 million, the calculation changes. You'll need 5% on that first $500,000 and 10% on the amount above that. Once you hit $1.5 million or more, you will need a minimum of 20% down. Period. No insurance, no exceptions. But here's the key: the amount you put down doesn't just change your mortgage. It changes your insurance, your interest rate, your closing costs, and your monthly risk exposure. So let's break it down. Let's look at how the down payment percentage actually changes your buying experience, because it's not just about what you qualify for, it's about how much cash you need, what your monthly will feel like, and how much flexibility you'll have after closing. If you go with 5% down, you're choosing the most accessible path in terms of upfront costs. Yes, you will have to pay mortgage default insurance that's provided by CMHC, Sagen, or Canada Guarantee, but that cost gets rolled into your mortgage, so you don't have to pay it up front. Your monthly payment will be higher than the other options, no doubt, but your cash required to close is lower, and that can be a smart trade-off, especially if you want to buy sooner rather than later, or if you're in a situation where preserving your savings gives you more breathing room. It works particularly well for households with solid income but less time to save. Now, if you go with 10% down, things start balancing out. You still pay mortgage insurance, but the mortgage insurance premium is lower than at the 5% option, which means you'll save a bit on the total loan. Your monthly payment will come down slightly and your equity position improves. But of course, you need more cash up front. That's the trade. You're putting more skin in the game, but your financing becomes more efficient. For a lot of buyers, this is the sweet spot, especially if they can pull in some help from their FHSA or the home buyer's plan to bridge the gap. And then there's the 20% down route. No mortgage insurance at all. You start off with more equity, your mortgage is smaller, and your monthly payments drop significantly. But here's the flip side: you need a lot more cash to make it happen. For most people, this isn't something you save on your own in just a couple of years. It usually comes from a combination of long-term planning, big income years, or support from family. If you have that backing, or if you're coming in from a sale or inheritance, it can be the cleanest way to enter the market. So, which one is right for you? It all comes down to your timeline, your comfort zone, and how you want to allocate your capital. Buying a home isn't just about getting in, it's about staying comfortable once you do. Now, let's talk about the tools that actually help you build your down payment, even if you don't have all the money saved yet. If you're a first-time buyer in Canada, you've got two powerful resources available to you: the First Home Savings Account, also called the FHSA, and the Home Buyer's Plan, or HBP. The FHSA is new and designed specifically for people like you. You can contribute up to $8,000 per year, up to a lifetime maximum of $40,000. What makes this account incredible is that the contributions are tax deductible just like an RRSP. But then, when you use the funds to buy your first home, the withdrawals are tax-free, just like a TFSA. That's a win on both sides. If you're even thinking about buying in the next couple of years, the FHSA should be part of your plan. It's not optional anymore, it's essential. Now, the second tool is the HBP, the Home Buyer's Plan. This allows you to borrow from your own RRSP up to $60,000 in total and use that towards your down payment. You're essentially loaning the money to yourself and you repay it over 15 years interest-free. And here's the bonus: even though you're withdrawing from your RRSP, it doesn't count as taxable income when you use it for your first purchase. Now, here's where things get exciting. You can use both of these programs together. That means if you've been contributing to an FHSA and you also have an RRSP savings and even have access to a family RRSP account, You can stack these together to make a bigger move even sooner. I've worked with clients who had less than $15,000 in cash, but because they used both the FHSA and HBP smartly, we were able to get them into a home with a 5% or 10% down strategy that worked without draining their bank account or overloading their monthly budget. This is what I mean when I say it's not just about how much you've saved, it's about how you structure your stack. And the way you combine these tools can unlock buying power much faster than most people realize. We recently sold this home in the West Island, located at 4435 Rue Kingston in Pierrefonds. Their asking price was $599,000. Let's walk through how the monthly payments would have changed based on your down payment. With 5% down, between down payment and closing costs, you'd need just under $50,000, and your monthly payments including taxes and home insurance would be about $32.75 a month. With 10% down, you'd need just under $74,000, and your monthly payments, again including taxes and home insurance, would be about $31.30 a month. With 20% down, you'd need just over $132,000, and your monthly payments, including taxes and home insurance, would be about $27.70 a month. These amounts may seem like a lot, but don't forget that you can use your FHSA or HBP for the funds. I also included closing costs in order to avoid a nasty surprise. So, how do you decide which capital stack is right for you? The truth is, a 5% down payment isn't worse. A 20% automatically isn't better. Each option comes with trade-offs, and the right choice isn't about pride or pressure, it's about alignment. You need to look at your full financial picture, not just how much you've saved, but also how stable your income is. Think about your comfort with risk. Are you someone who sleeps better with money in the bank, or are you comfortable putting more down if it reduces your monthly load? How long are you planning to stay in the property? What's your timeline? And most importantly, how do you want to live after the purchase? If putting 5% down gets you into a safe, quality home, lets you keep your emergency fund intact, and allows you to live with margin each month, then that's a smart move. It's not settling, it's strategic. If you've been saving for years, or you've got help from family and you're able to put 20% down to avoid mortgage insurance and lower your monthly payments, that's a win too. Especially if you're looking for long-term efficiency or planning to hold the property for a decade or more. But here's the thing. Most first-time buyers land somewhere in the middle, and that's not a problem, that's an opportunity. Because once we understand your numbers, your goals, and how you want your first year as a homeowner to actually feel, we can help you find that sweet spot. The one that's not just financially doable, but also sustainable. That's how we help people move smart, not scared. If you're thinking about buying your first home in Montreal, don't try to figure this out all alone. We walk first-time buyers through this process every single week. We'll sit down with you, look at your numbers, and help you figure out what's actually possible, whether it's 5, 10, or 20%. We'll show you how to build a smart stack, leverage your FHSA and HBP, and buy with confidence, not stress. Book a call with us, it's free, it's real, and it gives you a plan. And if this video helped you feel clearer about how this all works, like it, subscribe, and hit the bell. We've got more buyer strategy videos coming, plus listings and neighborhood breakdowns. I'm LJ Aguinaga, once again here in Montreal. Thanks for watching, and I'll see you on the next one.